Okay, let's get another perspective on that one. Pete McGuire, XM.com, is in our Sydney CBD studio. Peter, warm welcome into the program. We know that everything is basically priced to perfection. To sort of summarise Mark's just point gone there, what are you saying now is the kind of autopilot story for these markets versus some kind of a pullback on, well, just realising we have got an awfully pumped up with optimism, not a lot to trade off, though, in reality?
Well, good afternoon. Yes, exactly right. But when you think about what we've seen over the last matter of weeks, and if you'll take on board since the end of November, it's been a very strong uptick. Gold also, Carson, with the US dollar, and we discussed that in Mark's comments, you've seen that rally through 1200 now. And then we've got an OPEC meeting this weekend as far as the compliance and realising that everyone is really, I think, tipping their hat and satisfying the market from their cuts. And many producers are now saying that this will only run until the end of the first 6 months. So that's where our mindset is.
It's interesting. So we still fall back on the old mainstay of every move OPEC makes matters. But given the nature of shale in the US, are we disproportionately focusing on that cartel versus, you know, the new normal in energy markets?
Well, in some ways, yes, but we also take on board, and Mark's comments, you know, the US is producing at record numbers. Now, what we saw in the last couple of months out of the US has been very, very strong continued growth. And that's going to be interesting as crude and as all of these markets and all of these producers start to cut. It's going to see, I think the rally's going to be driven by the US, or the uptick is going to be driven as far as that production. And I think that where we're looking at the moment, I wouldn't be surprised, Baker Hughes, 10 out of the last 11 weeks as far as rig count increase. More rigs are coming online, Carson, so that means one thing, more production. So,
Pete, the number on that now is 659 for oil and gas, and for oil only it's 522.
Yeah.
So what that means is that's since this went through $45 to $50, that's what I was talking about. They're up by 2/3. The number of rigs are up by 2/3. There will be a top side at around this price, but it's still expensive if you want to drive your car.
Well, yes, but I think, Mark, that you'll see more rigs coming online. What's interesting is that their production costs have cut down now to $40.
Yeah.
So the price elasticity, or the worker elasticity, in the sense people will leave jobs, as we've discussed for many months, they're moving back onto the rigs, and with the production coming there, we're producing at 1/3 the amount of rigs is giving us the amount of oil that they were taking, you know, 100%, only going back 2 years ago. So new innovations and technologies. As more rigs come online, naturally more production, and I think it's going to play favourably for the states and, of course, for President Trump.
But, Pete, is it only about technology, or is it we're making people work more for less?
Well,
is it people in Nebraska who are saying, OK, it's a job, I better get on?
Exactly right. I mean, you know, one of the major talks at the World Economic Forum in Davos this week is exactly that matter. There's been no growth across the middle class for more than a decade. Your comments regarding, you know, friends in the US, and we all understand that part of it. It's a very contracted wage growth. And this is leading to alternative parties. We saw Brexit, we saw Trump, and what issues that'll play across Asia and leading into Europe, of course, this year.
But often we sort of sidestep rather the soft commodity story that's playing out now. It's intriguing because here we have a play on that via the markets in the form of Coca-Cola Amatil. It's had that footprint in Indonesia, hasn't really managed though to get its product mix right and find a willing uptake to the measure that it ever had dreamt it would. Now it looks as if Indonesia is set to become the world's second largest importer of sugar in the next 5 years. So consumption is rising. That's the kind of paradox. Coke can't square the circle on it, but consumption is definitely rising. Are you seeing this as maybe the quiet achiever in ag space, the sugar story?
Well, of course, but I think, you know, that demand picture, Carson, across all of Asia, consumption patterns are lifting through not only population and that demographic and, of course, great marketing, but they're getting that sweet tooth that, you know, we experienced 60 and 70 years ago in Australia and the US. Everything is just running behind. Coca-Cola, you know, the consumption there and those sweet drinks across Asia, Hong Kong, China, India, and into Indonesia. Big numbers, you know, and you've got population bases of 250 million up there. So that appetite is growing, and it's just going to be a growth story for a lot of those ag sectors. I think moving forward over the next, 15 to 20 years, that storyline hasn't changed, and it will only continue and probably be stronger. So if you don't see any crop problems and growth forecasts, I think it's going to be a very sweet time to be a farmer.
Well, Pete,
very sweet time, Pete. I love that.
If you had a choice, would you be a holder of gold stocks or ag stocks right now? Briefly, finally.
I think you'd have to look at gold for the short term. I'm very curious to see what happens as far as President Trump over the next couple of weeks. If the rally gets a bit of a knock on the head, we could see gold shoot up a couple of extra bucks. Wouldn't be surprised at another 20 or 30. So I'd look at that for the short term leading up to the end of the month, Carson.
Good to talk. Have a great week.
Thank you very much.